Hello and welcome to the video. My name is Brandon and today I'm going to be talking about mutual funds. They're one of the most important investment vehicles out there and it's one that you absolutely need to know about. Now before I get too deep into what mutual funds are, let's ask the question, why would we even use a mutual fund in the first place? Like what purpose do they serve? So let's assume that you just decided you want to invest, right? You got your asset allocation set, you want 60% in equities, 40% in fixed income. Now, in an ideal world, you would go out and you would build up your portfolio by buying the stocks directly. You'd go buy shares of Coca-Cola, Procter & Gamble, Johnson & Johnson, pick like 15 to 20 stocks. Of course, making sure you're getting exposure to all the different industries, and then maybe you go buy some bonds and your portfolio would be built. However, that can be very costly. I mean, when you factor in that a single stock can be like $100, a couple $100. Heck, if you wanted to go buy a share of Amazon, well, that's like $1,000 right there, USD. So if you're an investor with a smaller amount of money, how do you go about building a good diversified portfolio? Well, this is where mutual funds and ETFs become very important. In fact, if you want to invest properly, your only real viable option is to invest in a fund like this. And the best way to look at a mutual fund is it's like a basket. It's like a basket of assets. And those assets could be stocks. You could have a mutual fund full of bonds. You could have a combination of both. You could have a mutual fund strictly investing in gold companies or energy companies. I mean, there are literally thousands and thousands of different funds that you can choose from, all with their specific characteristics. And when you purchase a mutual fund, you're basically buying units of that basket. And how it works is that you take your money and you combine it with thousands and thousands of other investors. My money, your neighbor's money, your money. It all gets piled into this big mutual pool, hence the name mutual fund. And then a professional money manager or a professional investment manager is hired and is basically in charge of managing or investing that money based on the specific fund's mandate. In other words, when you invest in a mutual fund, the day-to-day investment management, that's left up to the fund manager. You don't pick whether to be buying Coke or Pepsi or TD or Royal Bank. That's the fund manager's job. As the investor, your job is to pick, well, what style of fund do you want to invest in? And mutual funds are what we would call actively managed. With a mutual fund, the fund manager is constantly adjusting the fund, trying to change the portfolio, change the investments within the portfolio in order to generate some additional return. He's basically trying to outperform the market or the benchmark. And this is one of the important characteristics about mutual funds that sets them apart from a fund like an ETF or an index fund, in that an ETF basically just tries to track an index and accept the return of the market, versus the mutual fund, which is constantly trying to outperform. And one thing that I want to know is when people think of outperform, they always think of the aggressive side, trying to get a higher return. A big part of active management isn't necessarily on the aggressive side, it's also on the defensive side. You can actively manage a portfolio with a defensive mechanism. For example, reducing your weighting to certain equities, or if you feel that a certain sector is overvalued, reducing your weighting to that sector. Now, who offers mutual funds? Well, companies like McKinsey, Fidelity, Trimark, CI, Franklin Templeton. These are all mutual fund companies that basically package up the funds. They hire the fund managers and they offer them out to the public, to investors like us. They're basically trying to attract our money. So McKinsey would have their lineup of funds, Fidelity would have their lineup of mutual funds, Franklin Templeton would have their own funds, as well as the banks. The big banks all have their own in-house funds as well. So as investors, we have to compare the different fund companies and see which one's the most appropriate for us. Factor in things like performance, the fund managers, costs, which we'll talk about in a second. So what are the benefits of investing in a mutual fund? The first one, very self-explanatory, diversification. Again, you can buy a single fund and get access to literally hundreds or thousands of different stocks or companies all within one fund. And that's something you otherwise would not have been able to do. A good example of that is, like, let's say you wanted to get exposure to the gold sector. Instead of buying one company, you could purchase like a mutual fund that has multiple gold companies, maybe some gold mining companies, maybe some gold retailers, maybe even like some companies that are in the gold bullion. I mean, it's just a far better way of getting, diversified exposure to a specific market. The second benefit to investing in a mutual fund, you're getting the expertise of a professional money manager. Again, every fund has a specific fund manager assigned to it, sometimes multiple fund managers, and their sole purpose is to try and get this fund to produce the best return as possible. And let's just flip over to the screen recording right here. So here's a little screen recording of a mutual fund. It's basically just a screen or a little snapshot of the mutual fund. And in this case, we're looking at a Fidelity fund. So this is one of the fund companies, and the fund that they're offering here is the Fidelity Canadian Growth Company Fund. And that's just the name they went with. The name could literally be anything they want. But as the name implies, you're likely going to be investing in Canadian equities or Canadian growth companies. So here on the left, we have some information on the fund, the price of the fund, so the net asset value right here, when the fund was incepted. So this fund's been around since 1994. Right over here, we have the aggregate assets. So this is all the money that's in the fund. So $3.7 billion is in this fund alone. And if you were to invest like 50 bucks, 100 bucks, well, it would go towards this big pool and then be invested. Below we have the fee, which we'll talk about in just a second. We got some performance over here, but what I want to show you, we have annualized returns. Scroll down over here. Here's the top 10 holdings. So this specific fund invests in TD Bank, Shopify, Rogers, CNR, Take-Two, Alphabet, also known as Google, Microsoft, Eldorado, PayPal. And these are just the top 10 of 93 holdings. So if you were to invest in this fund, again, you're getting access to 93 different companies, all with your like $50 investment or your $100 investment. So pretty cool. But what I wanted to show you here was this part right here. So this guy at the very bottom, the portfolio managers. And in this case, there's only one portfolio manager, Marc Schmelle guy. So this would be that investment manager that I'm talking about that's managing this specific fund. And again, for a different fund, there'd be a different investment manager. And like I said, these guys 9 to 5, their job is managing this fund. And of course they have, in-house analysts, teams working on their side to make the investment decisions. Now, I mentioned mutual funds have a low cost, which leads into our next section. Fees. Yes, mutual funds have fees. The companies don't package these up and offer them to you for free. They're trying to make some money too. And if you want to invest in a mutual fund and have all the benefits, well, you got to pay the fee. And there's 2 fees that are associated with any mutual fund. The first one is called the MER, the Management Expense Ratio. And this is basically the fee for the cost of the fund. I mean, it costs money to run a fund. There's analysts, there's compensation for the fund manager, there's paperwork, there's filings that they have to do, there's reporting. It can be quite costly. And for anybody that invests in this fund, the fund company takes a little bit of their investments. And the MER is stated in a percentage form and it's charged annually. So if a fund had a 2.5% MER and you invested $100 into this mutual fund, well, every year you'd pay $2.50 in fees. And this would be taken off automatically. And that's an important thing to know because there's a lot of investors who don't even realize they're paying a fee. Because it's taken off the top, it's not like you pay a separate cost or take out your credit card and get charged. It often slips through the cracks, but it's something that you absolutely need to be aware about.
What?
And the average MER would be like anywhere between 1% and 3%. It can be a little bit higher, it can be a little bit lower. But a very typical MER for, let's say, an equity fund would be, right about 2.5% range. And like fixed income funds tend to be a bit lower, so bond funds, simply because they're not as intensive to administer. I mean, you buy a few bonds, let them expire, buy some more bonds. In comparison to like an equity fund where there's a lot more hands-on work, you need to hire analysts, do a lot more research, especially like international equity funds. So if you had like a China fund,
China. I like China. I love China.
Or like a Japanese dividend fund, these funds would typically have the higher costs simply because they may need to base some analysts over there. It's just a more costly fund to run, and that would be reflected in the MER. Now, the second fee that's associated with mutual funds is called the sales charge or commission. As with most assets, you pay a commission when you buy them, you pay a commission when you sell them. Now, mutual funds have a couple unique options. The first one is called the front end or the initial sales charge. And this one's pretty standard. It's like if you had $100 to invest, well, you pay the commission up front. So you pay like $2 or $3 and the rest of the money gets invested. And when you go to redeem your units or sell the mutual fund later, you don't pay a fee to take the money out. That's why it's called front end. You pay the commission up front. Now, the second option, which is very important for a younger investor, is called the deferred sales charge or DSC or back end load. And how this works is that you don't pay a commission up front. So if you have $100 to invest, the entire $100 gets invested in the fund. But when you sell the fund, there's a potential fee that you may pay, hence the term back end. But notice that I say may pay. Let me bring up a picture here of the deferred sales charge scale. And this is pretty universal amongst all of the mutual funds. And let's take a look at how it works. So if you were to buy a fund today, and within 1 year of buying it, you decide to sell the fund, well, in that case, you'd be hit with a 6% fee or a 6% deferred sales charge. And that'd be the fee that you have to pay to redeem your units or to get your cash back. And that's a pretty substantial amount. That's nothing to look at lightly. 6%, at the end of the day, it's not the end of the world if you have to pay it, but ideally you don't want to pay that. What if you sold the fund within 2 years? Well, that fee drops down to 5.5%, or 3 years down to 5%, and so on and so on. And the longer you go, the fee gradually declines until after 6 years, you pay 0% in fees to sell your funds. In other words, if you plan to invest for 6 years or more, which is what I would highly recommend anyways, you pay no commission to buy the funds and no commission to sell the funds. So for a younger, long-term millennial investor, this would be the perfect option. Now, to clarify, you're still paying for the MER. That's a completely separate fee. That's ongoing, that's every year. This is just when you purchase and sell the funds. So to finish this video, all in all, mutual funds are a great investment product. Like I said, for a younger investor with not a whole lot of money, you pretty much have to go with a mutual fund or a fund like a mutual fund for at least the core of your portfolio. And if you want to buy stocks, absolutely, by all means, you can buy stocks too. But for the bulk or for the base of your portfolio, it should absolutely be in a diversified investment like this. So that's my video on mutual funds. I hope that I answered some of your questions. And in my next video, I'll be talking about ETFs or index funds, which are similar, but quite different in their own way. So if you enjoyed this video, give it a thumbs up and subscribe for more content. And thank you for watching, and I'll see you in the next video.